In January 2026, the President of the United States sent subpoenas to the Federal Reserve. Not a letter, not a phone call, grand jury subpoenas. The target was the man who controls your mortgage rate, your credit card APR, your car loan, the man who, more than any single person in America, decides what it costs you to borrow money. 3 months later, the president threatened him on television. Quote, "I've wanted to fire him. Then I'll have to fire him." Jerome Powell's chair term expired May 15, 2026. He was supposed to leave. He didn't. Sarah is a middle school teacher in Phoenix, Arizona. She makes $58,000 a year. She bought her home in 2019 at a 3.4% mortgage rate. She has a sister who has been trying to buy her first home for 3 years. She's been pre-approved twice. She's been outbid 6 times. Her rate today is 6.8%. That difference, 3.4% to 6.8%, adds up to $487 more per month on the same house, $5,844 more every year, $175,000 more over the life of a 30-year loan. That gap exists because of a number set in a building in Washington, and right now, 2 men are fighting over who controls that number. This video is about what that fight actually costs you, and why the man who was supposed to lose it is still standing. Here is what we are going to cover in this video. Chapter 1. Who Jerome Powell is, what the Federal Reserve actually does, and why one man has this much power over what it costs you to borrow money. Chapter 2. The 1913 law, one sentence, that became the most important legal shield in American monetary history, and why it has survived every challenge until now. Chapter 3. The full story of how the Trump administration attempted to remove Powell, the criminal subpoenas, the public threats, the DOJ investigation, and why every attempt failed. Chapter 4. Who Kevin Warsh is, what he has signaled about your interest rate, and what the transition from Powell to Warsh means for your mortgage, your savings account, and your cost of borrowing. By the end of this, you will understand exactly why the fight over the Federal Reserve is a fight over your money, not abstract, not theoretical, a specific number on a specific statement in your mailbox. Your money. Here is where the system stands right now. The federal funds rate, that's the interest rate that ripples out to set your mortgage, your car loan, and your credit card, APR, has been held at 3.5% to 3.75% for 3 consecutive Federal Reserve meetings, 3 meetings, 6 months, no movement. Meanwhile, the President of the United States has publicly and repeatedly demanded lower rates. He called Powell a numbskull. He called the Fed's policy pathetic. He threatened to fire the man running it. Powell held the rate anyway. Now here's why that matters. The Federal Reserve was not designed to agree with the president, it was designed to ignore him. That design goes back 111 years to 1913, and to a specific sentence buried in a piece of legislation most Americans have never read. In 1913, Congress passed the Federal Reserve Act. The goal was to create a central bank that could stabilize the American economy, control inflation, set borrowing costs, act as a lender of last resort when the banking system collapsed. But here's the problem Congress was trying to solve. How do you give an institution that much power without making it a political tool? How do you ensure that the person setting the cost of money is responding to economic signals, not to whoever won the last election? The answer was a clause, one sentence in 12 U.S.C. Section 242. It reads, "Members of the Board of Governors shall hold office for a term of 14 years, unless sooner removed for cause by the President." For cause. Not at the President's discretion, not when the President disagrees with monetary policy, for cause, proven misconduct, malfeasance, neglect of duty. In 1935, Congress went back and strengthened the clause. The revision made explicit what the original had left ambiguous. Policy disagreement is not cause. Wanting lower rates is not cause. Getting angry on television is not cause. The 14-year terms were designed deliberately to outlast presidential administrations, so that no single president could ever pack the board with loyalists the way FDR packed the Supreme Court. For 88 years, no president seriously tested it, until now. Jerome Powell was first appointed to the Fed board in 2012 by President Obama. He was elevated to chair by President Trump himself in 2018. Trump chose him over the incumbent Janet Yellen, believing Powell would be more accommodating. He was wrong. For the first 2 years, the relationship was functional. Then the Fed started raising rates to fight inflation, aggressively. 11 consecutive rate hikes between March 2022 and July 2023, the fastest tightening cycle in 40 years. And Trump started calling Powell his biggest threat and his biggest enemy. By 2026, the relationship had collapsed entirely. In January 2026, the Department of Justice sent grand jury subpoenas to the Federal Reserve, targeting Powell personally over a building renovation project at the Fed's Washington headquarters, a multi-year modernization of aging historic buildings that the White House had reframed publicly as an ostentatious misuse of federal funds, complete with claims of marble floors, special elevators, and rooftop gardens. Powell disputed every detail. He said the marble was replacement marble, same marble, broken pieces swapped out, no special elevators, no rooftop gardens. He went on video that Sunday evening, an almost unprecedented move for a sitting Fed chair, and called it what it was, quote, unprecedented intimidation. A federal judge agreed. The subpoenas were blocked. 3 months later, on April 15th, Trump issued a direct public threat on Fox Business, leave on your own, or I'll fire you. Powell's response was to stay, and then announce at his final FOMC press conference on April 29th that he would remain on the board as a governor, with a seat that runs through January 2028, the first Fed chair in nearly 80 years to make that move. Here's the part of this story that most people miss entirely. The for-cause protection has been tested before. Never through criminal subpoenas, but through presidential pressure campaigns that eroded the norm without ever legally breaking it. In the 1970s, President Nixon pressured Fed Chair Arthur Burns to keep rates low ahead of the 1972 election. Burns complied. Inflation hit 12% by 1974. In the late 1980s, President Reagan's advisors pressured Chair Paul Volcker so relentlessly that Volcker resigned in 1987 rather than continue fighting the White House. He was replaced by Alan Greenspan, who was seen as more politically accommodating. In both cases, the pressure worked, not through law, but through attrition. The chairs eventually bent or broke. What is different in 2026 is that the Trump administration went beyond informal pressure. It used the formal legal machinery of the state, grand jury subpoenas, criminal indictment threats, as the pressure instrument. That is a qualitative escalation, and it means that whatever precedent gets set from this moment forward will be set at a much higher legal and institutional threshold than anything that came before it. The for cause clause survived 2026. Whether it survives the next challenge depends entirely on whether any future president decides the courts are the obstacle, rather than the protection. To understand why that move matters, and why it directly affects your interest rate, you need to understand exactly how the Federal Reserve works. Think of the Fed as a thermostat for the cost of money. When inflation runs hot, the Fed turns the thermostat up. It raises the federal funds rate. Borrowing becomes more expensive. People spend less. Prices cool down. When the economy slows, the Fed turns it down. It cuts the rate. Borrowing gets cheaper. People spend more. The economy heats back up. That thermostat setting, the federal funds rate, is what determines your mortgage rate, your credit card's annual percentage rate, your car loan, your small business line of credit, the yield on your savings account. One number, set by a 12-person committee, controlled by whoever sits in the chair. The chair of the Federal Reserve does not vote on every rate decision alone. The Federal Open Market Committee, the FOMC, has 12 voting members. 7 are the Board of Governors, appointed by the President and confirmed by the Senate. 5 are regional Fed Bank presidents, rotating annually. But the chair runs the meeting, the chair sets the agenda, the chair speaks first, the chair calls the press conference after every decision and tells markets, banks, and governments around the world what it means. The chair is the signal. Everyone else calibrates around it. Here is what that looks like in practice. When Powell said in late 2021 that inflation was transitory, meaning temporary, not serious, markets believed him and held steady. When he reversed course in 2022 and called for aggressive hikes, mortgage rates doubled inside of 18 months. Not because of a law, not because of a vote, because the chair spoke and the market moved. That is the power Trump wanted to control, and that is the power the 1913 law was specifically designed to protect from him. Now here is what the April 29th vote revealed about what happens when that protection starts to crack. The FOMC voted 8-4 to hold rates steady, the most divided vote since October 1992. 1 member wanted cuts immediately, 3 members wanted to strip the easing language entirely, signaling they don't even want the committee to hint at future cuts, and 8 members held the middle ground. 8 members, 4 dissenters, 2 opposite directions. That is not consensus. That is a committee that is already fracturing before the new chair walks through the door. Now here is where the "for cause" clause becomes the most consequential sentence in American financial policy. The president can appoint a new Fed chair. When a term expires, that part of the system is working. Powell's chair term expired May 15, 2026. Trump's nominee, Kevin Warsh, cleared the Senate Banking Committee on April the 29th, the same day as Powell's final FOMC meeting, on a 13-11 vote. The first fully partisan committee vote on a Fed chair nominee in the institution's history. Every yes was Republican, every no was Democrat. But Powell didn't just hold the chair, he held a governor's seat, and his governor term doesn't expire until January 2028. To remove Powell from that seat, Trump would need to prove cause, not assert it, not tweet it, prove it in a federal courtroom under a legal standard that no president has ever successfully met against a sitting Fed governor in 111 years of the institution's existence. The DOJ tried to create that cause artificially. They opened a criminal investigation into the building renovation. They sent grand jury subpoenas. They threatened a criminal indictment over Powell's Senate testimony about marble floors and elevator specifications. A federal judge blocked the subpoenas. On April 24, 2026, 5 days before Powell's final meeting as chair, U.S. Attorney Jeanine Pirro announced the DOJ was closing the criminal investigation and handing it to the Inspector General. The legal maneuver had failed. Powell was still there, and now he had a voting seat at the FOMC table until 2028. Senator Thom Tillis, a Republican from North Carolina who had been blocking Warsh's nomination in committee to pressure the DOJ into dropping the probe, voted yes the moment the investigation closed. That sequence, the probe opens, Tillis blocks, the probe closes, Tillis flips, tells you everything about what the probe was actually for. Here is why a single governor matters on a 12-person committee. Kevin Warsh, once confirmed as chair, will set the agenda and lead the press conferences. He has committed, publicly and on record, to moving quickly on rate cuts. The Trump White House has made lower rates a stated policy goal. Warsh has aligned himself with that preference. Markets have priced in that alignment, moving expectations for the first Warsh-led cut from June to July 2026. But every rate decision still requires a vote. Powell, as a governor, gets a vote. A dissent from a former chair, the man who held rates steady through 3 consecutive meetings, who withstood criminal subpoenas and public threats to do it, carries institutional weight, not just in the committee room, in the bond market, in the mortgage market, everywhere that reads Fed signals for a living. And Powell is not the only friction point. Those three hawks who dissented at the April meeting, the ones who didn't even want the easing language in the statement, they are still on the committee. They don't want cuts. They want tighter policy. A new chair pushing for cuts, a former chair potentially dissenting, three hawks pulling in the opposite direction, and one member who wanted cuts yesterday. That is the committee Warsh inherits. That is not a unified institution. That is a committee that has never been more divided and more exposed to political pressure than it is right now. Here is the crack. The Federal Reserve was sold to the American public in 1913 as an independent, apolitical institution, a technocratic body that would make cold, data-driven decisions about the cost of money, free from the pressures of election cycles and partisan politics. That was always partially fiction. Fed chairs are presidential appointees. The Senate confirms them. The political system has always had a hand on the dial. Presidents have called Fed chairs. They've applied pressure through back channels, through public comments, through the appointment process itself. But there was a line, a norm, that no administration had pushed all the way through until now. The Trump administration didn't just push the line, it deployed the Department of Justice, the criminal justice apparatus of the United States government, as a pressure instrument against the central bank. That is not a policy dispute. That is not a disagreement about dot plots and inflation targets. That is the executive branch using the threat of criminal prosecution to attempt to gain control of interest rate policy. The DOJ probe was opened in January. It was closed on April 24th, 5 days before Powell's final FOMC meeting. U.S. Attorney Jeanine Pirro announced the closure and added for the record that she would not hesitate to restart a criminal investigation should the facts warrant. That sentence was left in the public record. It is still there. And if the for cause clause had not held, if the courts had not blocked those subpoenas, there is no institutional check that stops this playbook from working the next time someone tries it. Powell said it plainly at his final press conference on April 29th. He called the administration's actions unprecedented. He called the DOJ probe a pretext. He said Fed independence, the separation of monetary policy from political pressure, is at risk. That language from a sitting Fed chair is not normal. Fed chairs don't talk like that. They use words like uncertain environment and data dependent. They do not name the president as a threat to the institution they lead. The fact that Powell said it, calmly, at a podium, on the record, tells you something about how serious the breach was. And here is who benefits from the breach. Anyone who profits when interest rate decisions are made for political reasons rather than economic ones. The financial institutions that want cheap money, the real estate developers who borrow at scale, the corporations that carry leveraged debt. The people who do not benefit, anyone who holds savings, anyone on a fixed income, anyone whose retirement account depends on inflation staying controlled, anyone like Sarah's sister in Phoenix still waiting to buy that first house, who needs rates to come down for the right reason, not the political one. Remember that $175,000 figure from the top of this video, the extra lifetime cost Sarah's sister in Phoenix carries because the rate she's borrowing at is 3.4 points higher than what her sister locked in 2019. Here is exactly what the next 18 months look like for her, and for people like her, depending on who actually controls that thermostat. Sarah's sister, Phoenix, Arizona, pre-approved at 6.8%, waiting on the sidelines since 2023. Markets are currently pricing the first Warsh-led rate cut no earlier than July 2026. If Warsh moves quickly and the FOMC follows, she might see 6.2% by the end of the year. On a $350,000 home, that's $74 less per month. Meaningful, not transformative. But here's the risk she isn't being told about. If the Warsh Fed cuts too fast, for political reasons rather than data reasons, inflation at 3.3%, already running hot on oil prices from the Iran war, can accelerate. The Fed then has to reverse course, rates go back up, the window closes again. The best outcome for Sarah's sister is not fast cuts. It's the right cuts, at the right time, for the right reason. And the difference between a politically driven cut and the right cut is the exact question this entire fight has been about. David is a 61-year-old retired postal worker in Cleveland, Ohio. He put in 34 years. He retired in 2023 with $240,000 in savings, split between a money market account and a short-term CD letter. At current rates, the money market is earning 4.1% annually. On $100,000, that's $4,100 a year. His CD matures in August. If Warsh cuts aggressively, 100 basis points over 12 months, which is in line with what the Trump White House has signaled it wants, David's money market yield drops to roughly 3.1%. That's $1,000 less per year, $83 less per month, on a fixed income that is not rounding error. When his CD matures in August, he'll roll it into whatever rate the market is offering at that point. If Warsh has already cut twice by then, David locks in a lower rate for the next 12 months. There is no version of that story where David benefits. The political pressure for rate cuts is framed publicly as relief for borrowers and first-time homebuyers. And it is, for them. But every rate cut is also a transfer, from savers to borrowers, from the retired to the leveraged, from people like David to the real estate developers and corporations that carried large floating rate debt. David didn't vote on that transfer. He just watches the number on his quarterly statement go down. Marcus runs a small landscaping company in Memphis, Tennessee. 8 employees, 6 trucks. He has a $180,000 business line of credit tied to the prime rate, which moves in lockstep with the federal funds rate. Right now, he's paying 6.75% on that line when he carries a balance through the slow winter months. That's roughly $12,150 a year in interest at full draw. For Marcus, rate cuts are unambiguously good news on the borrowing side. Every 25 basis point reduction saves him approximately $450 a year on that line. 2 cuts, $900 back in his operating budget. 4 cuts, $1,800. That's a new piece of equipment. That's another employee. But Marcus also runs 6 diesel trucks, and he buys fuel every week. Fuel costs are up 10.9% year over year. A direct result of the Iran war driving oil prices. That's already costing him an estimated $8,400 more this year in fuel than last year. If a politically driven rate cut reignites inflation, and oil prices push further because the underlying cause, the war, has not been resolved, Marcus's fuel bill rises faster than his interest savings. The cut that was sold to him as relief ends up costing him more than it saved. That is what happens when the thermostat gets adjusted for political reasons, in a room where the people turning the dial don't fill up a diesel truck on a Tuesday morning in Memphis. Here is what the ledger says. The Federal Reserve was designed to do one thing above all else: make monetary policy decisions based on economic data, not election cycles. That design was not accidental. It was written into law in 1913 and strengthened in 1935 by people who had watched what happens when governments control the price of money for political reasons. They had seen it produce hyperinflation, depression, collapse. Jerome Powell did not hold interest rates to protect himself. He held them because the data said hold. Inflation at 3.3% with an energy shock still running is not a data set that calls for cuts. And Powell knew that cutting under political pressure, even if the number looked defensible, would permanently alter what the Fed's signal means to every market participant in the world. Kevin Warsh may be right that rates need to come down. The economics may well support it. But when a Fed chair cuts because the president demanded it, not because the data warranted it, the credibility of every future Fed signal is diminished. And it is that credibility, built over decades, not days, that keeps your mortgage rate from being set by panic, by political cycles, by whoever won the last election. What the ledger actually shows: the fight over Jerome Powell was never about a building renovation. It was about who controls the thermostat, Powell used a 111-year-old sentence in federal law to hold his position against a president, a criminal probe, and a public smear campaign. He is still there. The seat is still his until 2028. Whether his successor has the same protection or the same will to use it is the most consequential open question in American monetary policy today. And your rate is the answer. If this is the first video you've landed on, this is what we do here. The story underneath the story. Subscribe to American Ledger Journal. Hit the bell so the next one finds you. And if this gave you something worth passing on, send it to someone who needs it.